now, yeah. Okay, so Kesara, how has been like lockdown?
So far so good.
Okay. So what do you do most of the time?
In the beginning, it got a bit boring because we didn't really had anything to do. But then I tried starting a few online courses.
Perfect. Yeah, that's good.
And I just followed another trend. I started cycling, so I do that every day.
That's good. That's good. Yeah.
So just trying to make the most out of it. But it's fun being home after so long with nothing to do. So that has been good so far.
And do you have some other courses as well? I mean, besides financial accounting?
Yes. From this week onwards, all courses have started their lectures and recorded classes.
Oh, okay,
so everything's in full swing right now.
Oh, okay, perfect. And Junaid, what about you? कैसी जिंदगी गुजर रही है?
Life is good, sir. I'm mostly at home and attending online classes.
That's good. That's good.
Doing assignments and all that.
Okay. So what I'll do, Junaid, actually, I'll share all the material with you through emails.
Okay, sir.
Does that make sense? Do you have access to CMS anymore or no?
Sir, I have access to CMS, but I am not seeing my courses registered. The status that was in the start of the semester, that's not at the moment. I'm just my CMS is opened. I can open it, but I don't have fully access to it. I don't see my courses in it. I can't see any assignments or attendance status. So that's a better platform through CMS.
Okay, so I'll upload all the course material on CMS, but I will also share those material with you through email.
Okay, sir.
Okay, we'll make it work. Don't worry.
Sir, I sent them an email yesterday, and maybe they'll give me the full access to my CMS, and I'll share with you when they give me the full access. I'll share with you the thing.
Okay, perfect. Perfect. Okay, let me share my...
Sir, how has lockdown been for you so far?
Well, it's not bad. I had some plans in mind, but unfortunately couldn't materialize. For example, I had plans with my kids. We wanted to go actually camping.
Are you in Pakistan or Canada?
In Canada. I booked camping sites and everything is in ruin actually. So I had to cancel everything.
When did you go back to Canada?
I did not go back to Canada at all. I was planning to go back, but there are hardly any international flights.
Oh, I thought you said you were in Canada. Oh, my bad.
No, I'm not in Canada. No.
But so what about those? Earlier, I think a month ago, all those Canadians who wanted to go, they took them.
Yes, yes. Actually, they were pushing us. Not pushing us, but actually they were recommending us to go back. But the problem is, I had to complete my semester. I could not leave you guys in the middle.
Fair enough. Fair.
Okay, so let's start. Okay, somehow I do not see. Okay, right here. Okay, perfect. So can you see my screen right now?
Yes, sir.
Oh, okay, perfect. All right. Okay, so as I told you in one of my lectures, I think it was like the introduction part. Online lectures are very tricky. So what you need to do, whatever I upload online, please go through it right away. Okay, go through it right away. And the reason is, of course, my lecture number 2 will build on lecture number 1. So if you do not get a chance to watch lecture number 1, you will be clueless in lecture number 2. So I recommend watching lectures I'll try to actually make short videos, not very, very long videos. So it will be around maybe 30 minutes. So we will have a minimum of one interactive session. And I recommend that we do it on Thursdays. And then I'll give you 2 recorded sessions. The interactive session, I will also record it. So let's say, and it will be actually on your timeline for Microsoft Teams. So let's say if you would like to go back and would like to watch the video again, that should not be a problem.
Okay. So why can't we have all 3 interactive sessions, like live sessions?
Okay, so let me take Junaid's opinion. Junaid, what do you think? Do you prefer recorded or do you prefer recorded and live sessions?
Sir, both are fine with me. I mean, 2 interactive sessions are good enough. 3 would be a burden for us, as we are taking 5. I am taking 5 courses and I have every course interactive session in a week, in a day. So I won't be free. So, okay. So 2 interactive sessions would be enough.
Yes. The best part, in my opinion, for interactive session is no matter you like it or you do not like it, I'll still make you sit actually in front of your computer and I'll make sure that you read the stuff. So yes, there is a benefit, but at the same time, yes, I understand that we have 5 different courses and maybe a little bit practically difficult. So let's not worry about that. We will discuss it and we will discuss it in detail. Okay, next week.
Okay.
Okay. So in this chapter, actually, we will talk about long-term liabilities. So if you remember from chapter number 10 to chapter number 14, we covered, for example, fixed assets. We covered, let's say, current liabilities. We covered about partnerships, that how partnerships are formed and how the income is distributed, how the partnerships are actually dissolved. So we talked about the mechanism of those partnerships, and we also talked about the accounting of it. In today's lecture, actually, we will talk about long-term liabilities. So as you know, balance sheets, on the liabilities side, you have current liabilities and then you have long-term liabilities. Okay. So today we will talk about long-term liabilities. In this lecture, I will only cover the first part. So this is our chapter outline. So today we will cover only the major characteristics of bonds. So whenever we talk about long-term liabilities, mostly it means bonds. Okay. And then in the second step, which will be the next lecture, we will talk about some accounting for bond transactions, and then accounting for long-term notes payable, reporting, and then analysis. Now, long-term liabilities, as the name suggests, they are actually payable in more than 1 year. So these are not the immediate liabilities that as finance manager you should be concerned. The immediate liabilities are current liabilities. And current liabilities are the liabilities which actually hits your liquidity very hard. So finance managers, they are very, very vigilant about their current liabilities because those liabilities are payable within 1 year, and the managers are more concerned about those liabilities. So they do not want to go, let's say, default or bankrupt because it's not a good, it doesn't send a good signal to the market. So long-term liabilities are, of course, they are obligations. And then the company is expecting to pay those liabilities not in 1 year, but beyond 1 year, more than 1 year. And of course, long-term liabilities are reported on the balance sheet and under a separate head. So if you remember a balance sheet, normally the way it looks like, for example, you have accounts payable, and then you have some other, let's say, accruals, and this makes your current liabilities. And then, for example, you have your notes payable, let's say, if they are long-term, and then you have bonds and any other long-term security, right? And they make actually your long-term liabilities. So almost all balance sheets, whether in Pakistan or let's say any other country, they normally categorize their long-term liabilities and they classify them under long-term liabilities under one head. And then, of course, it has some subheadings.
Sir, what else can you put in the current liabilities category besides this accounts payable, apart from this?
So normally I would say notes payable, they come here. And for example, let's say your accrued, let's say your income tax is payable to the government.
Okay.
Okay.
Okay, sir.
Yes. All those liabilities which are payable within 1 year. So you put them in current liabilities. Okay. So it's not the headings, it's actually the maturity which defines whether it should be a current liability or a long-term liability. Okay? Okay. Now bonds. Bonds are a form of interest-bearing notes payable. So bond, it's like a security, but it's interest-bearing. So all bonds, of course, the bond holders are getting income, and the income is coming in the form of interest. So they are earning interest on their investment. Bonds are issued by corporations. They're also issued by universities and government agencies, and also very popular among municipal governments, like municipalities. Bonds are like common stock and are sold in small denominations. Okay, so bonds are traded on. They are traded in where? Capital markets. Okay, they are called exchange traded securities. Exchange traded. So they are actually traded on exchange. So let's say if you are finance manager of a company and you have some savings, you have some surplus cash, and you think that, okay, let me invest this money somewhere. So, and you're more concerned about, let's say, fixed income, and you think that, okay, rather than buying a common stock of a different company, I would like to buy bonds, because the best thing about bonds is their income is fixed. Common stock, if you remember, common stock, what do you get? You get actually dividends, and dividends are not fixed. So let's say a company may give $2 per share dividend, $3 per share dividend, and they may not even give you a dividend. Let's say if they do not make any money, or even if they would like to retain all the money, they do not give you any dividends. So dividends is not fixed. Bond income is fixed. So as a finance manager, it's much easier for you to plan. So let's say if you are holding a bond portfolio, which means that you invested your money in different bonds, you can easily predict that, okay, in the next 1 year, this is the kind of money that I'm getting as a return on those investments. Is it clear, Humayun?
Yes, sir, it's clear.
Okay, perfect. And Junaid, is it clear?
Yes, sir. Yeah.
Perfect.
Yes, sir, okay. I'm getting it.
Okay. Normally, in US, the bond has a face value of $1,000, and it's called face value, and it is also called par value. Okay. Okay, so bonds attract many investors.
Sir, can you repeat this? What is face value and par value?
So whatever, like for example, if you have a $100 note, like the currency note, okay, so it's here. It's written on that piece of paper. That value is called face value. So whatever is written on the face of that piece of paper, it's called face value. But the other term that we also use is par value, par, P-A-R. Is it clear, Humayun?
Yes, sir.
Okay, perfect. So when a corporation issues bonds, it is borrowing money, of course. So suppose, let's say Pakistan Tobacco Company. So Pakistan Tobacco Company. So if they issue a bond, in a way, they are borrowing money. So they are selling bonds and they are getting money. and whatever they get, it's like borrowing for them. So it is showing on their liability side. It is recorded on their liability side. On the other hand, if investor is buying it, of course, the person who buys the bonds, the bondholders, they are called investors, and they are investing their money in bonds. Okay. So there are two parties, one party who is selling the bonds and one party who is buying. The party who is selling bonds, they are borrowing money, and the party who is actually buying those bonds, they are investing their money. Okay, so they are investing their money in bonds.
Okay.
Okay. Now there are two types of bonds. One is called secured, and the other one is called unsecured. Okay, and as the name suggests, these kind of bonds actually have a specific asset of the issuer pledged as a collateral. So some companies, let's say if they are new in the market, or let's say if they do not have a long credit history, what they do, they normally issue secured bonds, like for example, mortgage bonds. So mortgage bond, the security which is given as a collateral against those bonds is real estate, just as in this picture. So this bond is issued and they give real estate, these buildings or land, anything, right, as a security. So those bonds are secured by a certain collateral. Okay, so what does this collateral do? Junaid, can you tell me?
Sir, I have not taken this point, this collateral thing, sir.
Sorry, say it again, Junaid.
Sir, I have not taken your this last point, this about collateral pledged collateral thing. I'm not getting this.
Okay, so let's say if you, Humayun, do you have any idea?
Sir, what was the question? That why they keep something in collateral?
Yeah, so secure bonds are those bonds against which, let's say, a company gives some asset as a collateral.
True, but right? What was the question? Why they do this?
My question is, why collateral? What does collateral do?
In case they are unable to pay, so then they could take that collateral as their own.
Perfect. Okay.
Just like
it's a kind of security
loan.
So no, that's a very good answer. Yeah. So let's say if you go to a bank, okay, and you apply for a loan. So you can either apply for a secured loan or unsecured. Secured. So secured loan would be, let's say, if you borrow from a bank and then they, let's say, take, let's say, your agriculture land as collateral. Okay, so that would be like a secured lending. But some banks also, let's say, if you have a very well established credit history, for example, let's say if you're Agro Fertilizers, good solid company, right? And if that bank, if Agro Fertilizers need, let's say, a line of credit, what they call line of credit. So of course, Agro Fertilizers has to make some payments, and sometimes their cash is not enough. So what they do, they apply for an unsecured line of credit. So they do not give anything in collateral, and they get, let's say, for example, let's say 100 million rupees. They call line of credit. LC is like a letter of credit, but line of credit. Okay, so line of credit is unsecured. Agro Fertilizers did not give anything as a collateral. So let's say if something happens, the bank do not have anything to resort to recover their money. It's gone. Okay. But since, I mean, Agro is such a solid company, bank will be very comfortable lending them, let's say, 100 million.
Let's give them the money.
Unsecured.
They'll pay the money back. Yeah.
Yes, exactly. They can easily pay. Another example of secured bond would be sinking fund bond. Any idea about sinking fund bond? Junaid, any idea?
No, sir. No.
No idea. Okay. Humayun, any idea?
No, sir.
Okay, that's okay. This is something probably new for you. So some companies, when they issue a bond, they give something as a collateral, but what they can do is they can open an account. So they open an account and then they deposit money in that account. And what is that money meant for? The money deposited. This is one example, actually. There can be different sinking funds as well. Money deposited is meant for bond payment. Of course, if a company sells a bond, at the end of the maturity, what they call bond retirement. So you have to retire the bond, which means that you have to give the principal amount back to the investor, right? So in order to make sure that at the time of maturity, the company has enough money to pay off their bonds, they open an account and they keep on depositing certain money. So just to give you an example, for example, a company has sold, let's say, certain, a bond of a certain value, and they think that, okay, at the maturity, which means after 10 years, let's say, they need to pay $10 million for retiring those bonds. And from bond retirement, I mean that they have to buy those bonds back. In other words, they have to give money to the bondholders, okay? So in 10 years, they need $10 million, right? So they keep on depositing, let's say on monthly basis or let's say yearly basis, some money in a specified account. And that money is meant for bond retirement. That fund is called, actually, that type of bond, which is issued against a sinking fund, it's called sinking fund bond. So they create a sink fund. This fund is called sink fund. Or let's say, another example, let's say, if my children, and I do that actually, if I'm thinking that okay, let's say my son turns, let's say 20 years old, like 5 years from now, he will start going to university. I open an education account and then I keep on depositing, let's say, to that account. It's like a sinking fund. That fund is only meant for educational payment. Is it clear now?
Yeah, sir. Got it.
Sir, is this something like when you keep money in the bank? So at times when they tell you to keep it somewhere and you can't touch that money and you'll get interest payments on that. Is this like that?
No, like normally the deposits are not kept for a specified purpose, right? So let's say if you have an account, you have a saving account, of course you get a return on that, but you can utilize that money for any purpose, right? Sinking funds, once you deposit money in that account, you cannot utilize that money for any other purpose. The only purpose that money is meant for is actually bond retirement at the time of maturity. Yes?
Okay.
Perfect. Okay. Now, unsecured bonds, they are also called debentures, are issued against a general credit of the borrower. Companies with good credit ratings use these bonds extensively. So, for example, let's say if Microsoft would like to, let's say, raise some capital through bonds. So do you think they need any collateral against those bonds? I mean, it is such a huge company, such a successful company. They do not need any collateral. So investors will happily buy those bonds even without any collateral. They are buying those bonds based on the general credit of the borrower. So it's like the general credit of the borrower means credit worthiness. Okay. And everybody knows that Microsoft has a good credit. They are very credit worthy. I will very happily lend them money. Okay. Now there are some features attached with bonds. So for example, some bonds are convertible and some bonds are callable. So convertible bonds, as this picture suggests, it can be converted into stocks. So bonds, of course, it's a fixed income security, it's debt, right? So it can be converted into stocks, right? Now, stock is, of course, it's stock, it's shares, right? So you own the company. So instead, and it is actually at the bondholders' option. So it's at the discretion of the bondholders. The bond issuing company, like the company who is selling bonds, they cannot convert bonds into stocks. It is actually at the discretion of the buyer. And not every bond can be actually converted. Only the convertible bonds can be converted. So it has a clause actually. It has a clause. Okay. So bonds, it's debt, but of course at bondholders' discretion, they can convert it into ownership. Okay. Now bond and stocks, they have different like risk and returns. That decision, whether the investor would like to keep that instrument as a bond or convert it as a stock, as I said, it has, it's the discretion of the bondholder. So let me recap it for you. Bonds that can be converted into stocks are called convertible bonds. The conversion feature is generally attractive to bondholders. Now, why is it attractive? Junaid.
Because, sir, they find some kind of incentive in this. By doing this, they find some kind of benefit, and that's why they convert their bonds into the common stock or stocks.
Okay, yeah, that's fair. That's very fair, actually. Humayun, there is a very good reason for it.
For converting bonds?
Yeah, why this conversion feature is more attractive for bond holders? Why is it attractive?
Sir, honestly, I don't get this part because according to me, bonds are like secured fund. But when you convert it into stocks, I think then there's a lot of uncertainty to it. So I don't see why it'll be better to convert it to the stocks.
Yeah, but this feature is very attractive, the statement says, and I will convince you that it is actually attractive. Why is it attractive? Okay, let me tell you. So as you can see from the first statement, that the bonds that can be converted into common stock at the bondholder's option. Can you see this word, option? So it's an option, right? It's not an obligation.
Not compulsory. Yeah, it's not compulsory. They can do it or they can't.
Exactly.
They don't want.
It's not an obligation. Okay. So if they think, as Junaid said, that converting this bond into equity, if it's beneficial, they will do it. Because stocks, normally, they are risky. Yes, Humayun, I agree. But more risk comes with more return. So they are risky. Yes, risk is high, but return is also high. Plus, it's ownership. So there are benefits to it.
Okay.
Okay. But of course, it's an option. If they think that, okay, no, the company is not going in the right direction, and they may or may not give us, let's say, dividends, you can keep it. You can keep it as a bond. It's your option. So is the attractiveness clear now?
Yes, sir. Totally.
Perfect. Okay.
Sort of.
Okay, sort of. So you are not fully convinced yet?
No, sir.
Okay, so if you're not convinced, you can actually keep it as a bond.
It's just that if you convert it to stocks, there's a chance that you'll earn more money, right?
No, but the option Humayun itself means that it's not an obligation. So you choose better of the two.
Yes, I get that part, but if you choose to convert them into stocks, the only attractive part is that in case the stock level rises, the price of or the worth of stock rises, you'll get more benefit, right?
Yes.
But it could be the other way around too. So it's 50-50.
Oh, it can be other way around. I mean, all investments are like that. You can only make an informed, the other word is data-driven decision or calculated decision. But of course, there is no guarantee.
So what if that you have bonds in a company and the company applies for bankruptcy or something? What happens then?
Yes. So let's say if the company bankrupts, and let's say if they file any bankruptcy, bondholders, like debt holders or any bondholders, they take priority, or common stockholders and preferred stockholders. Okay. So they take priority, then preferred stock, and then common stock. So common stock is actually, they have a residual claim on the assets. And when I say residual claim on assets, do you know what I mean?
Sorry, your
sir, the leftovers basically, sir.
Perfect. Okay.
Sir, your voice was disconnecting. Can you repeat that again?
Okay. So whenever a company files for bankruptcy, let's say if they do not have, let's say, enough money to pay off their creditors, they file for bankruptcy. So bankruptcy, what they do, they actually dispose of all the assets of the company. And whatever they get from that pool of money, bondholders takes priority over stockholders, and stockholders are preferred stockholders and common stockholders. Whatever is left, preferred stockholders are paid at number 2. And then whatever is left, they are given to common stockholders. So common stockholders have the last or the residual claim on assets. And why would, let's say if a company bankrupts, right? It doesn't mean that, let's say, the bondholders are losing money. So for example, let's say the company has huge fixed assets. So they have land, buildings. Of course, you cannot sell buildings and, let's say, sell land and then pay off your creditors right away, like the short-term liability especially, right?
Money can be retrieved by this source as well.
Exactly. And then through the court order, actually, they can sell those assets and they can create a pool of money, and then bondholders and stockholders are paired, accordingly. Okay. Yes, now, bonds that the issuing company can redeem at a stated dollar amount prior to maturity are called callable bonds. So sometimes, for example, let's say a bond has 10 years maturity. Okay. Some bond has a callable feature, and this callable feature is actually at the discretion of the bond seller. So the company who sells the bond, they have the option to actually call those bonds. So let's say after 3 years, they think that, okay, we should buy our bonds back. They have the option to buy them back. So there is a callable feature on the bond. Clear?
Yes, it's clear.
Perfect. Okay, so this is how the bonds look like in paper version. Exchange traded bonds, normally you buy those bonds and you do not get the paper version of it. But let's say paper version looks like this. This is the name of the company. Okay, so this is the bond issuer. This is the maturity date, May 1st, 2021. Okay, this one is the interest rate and it's due 2021. Okay, and this one is par value, sorry, face value, or par value, same thing. Okay, so let's say after 1 year, this bondholder will get how much? 5,000 multiplied by the interest, which is 5.75. Okay, this is as a coupon. This is coupon rate. Clear? Okay, so by investing $5,000, this investor will get 5.75 return. So at the end of at the end of each year, it really depends. Actually, it says in this description, it really depends whether the coupon is payable within, let's say, quarterly, or let's say half yearly or yearly. But let's say if it's payable yearly, then the bondholder will get 5,000 multiplied by 5.75% coupon or return at the end of each year. Okay. Now, issuing procedure. How are these bonds issued? Number one, it's the state. It's not the federal government. In the US, it's actually the state government which grants power to corporation for bond issuance. Board of directors and stockholders approve bond issue, and board of directors must stipulate the number of bonds to be authorized, total face value, and the contractual interest rate. So if I go back, the number of bonds, like how many bonds, like for example, if the face value of a bond is 5,000, how many bonds do we need to issue to the market? Like for example, the government of Pakistan, I think it was like 3 or 4 months ago, they tried to sell some, I think they called it Sukuk bonds. They tried to float it in the international market, and they tried to, I think, get a certain target. I think it was like $2 or $3 billion. Okay. So how many bonds? Its face value and the contractual interest rate. So for example, this interest rate is decided by the board of directors.
Okay.
Okay. Indenture. Indenture is actually a legal document. Okay. And that legal document contains all the terms and conditions of the bond. Like for example, the bondholder will get coupon, let's say, quarterly. Okay. The bondholder that has, let's say, he or she has the option to convert that bond into stocks. Let's say if it's a convertible bond. Okay. So all the terms and conditions of that bond are contained in that legal document. That legal document is called indenture. And it also summarizes the rights of the bondholders and their trustees as well. So it's like a legal document. Now, for calculating the market value of a bond, of course, we heavily use the concepts of present value. Okay, so this statement, if you had $1 million today, you would invest it, of course. From that investment, you would earn interest such that at the end of the 20 years, you would have more than $1 million. Thus, if someone is going to pay you $1 million 20 years from now, you would want to find out its equivalent today. So for example, if you have $1 million today, and then so this is year number 1, and this is year number 20. Okay, so let's say $20 million. Let's go with the example. Oh, it's 1 million. So okay, so 1 million. Okay, so you will invest it. Let's say the interest rate is 10%. Of course, after 20 years, you will have more than 1 million. So of course, you will have your principal amount, and then you will have your interest income. But what if, let's say, somebody tells you that, okay, I will give you $1 million in 20 years. Like after 20 years, I'll give you $1 million. So I would like to sell you a security, a bond, which promises to pay you $1 million in 20 years. What is the value of that bond? Okay, so of course you have to calculate what they call present value. Okay, and I'm sure from financial management course you will still remember future value equal to present value into 1 plus I, which is the interest rate, raised to power n. N is what? N is the number of years. 20 in this case. Yes. I is 10% here. Okay. And then present value in this case, in this particular example, is 1 million. But let's say this is example number 2. So in example number 2, your present value is something that we need to calculate. So future value divided by 1 plus I raised to power n. So future value in this case is this $1 million. Okay. So very, very simple concepts. So market price of a bond, the current market price of the bond is the value at which it should sell in the marketplace. Okay. But of course, as I said, these bonds are exchange traded. So they are traded on exchange all the time. Okay. So whatever rate that you see on the screen, that is actually the market price of that particular bond. And the market price of that bond, of course, depends on what? It depends on the riskiness. How risky is a certain company? So for example, let's say Microsoft. Bonds, and let's say we have bonds for, let's say, Bilal and Company, let's say, Bilal and Company, okay? So Microsoft, and let's say if they're both of them are operating in the same economy, let's say US, okay? If the return on Microsoft bond is, let's say, 8%, do you think, will you be willing to pay, like to expect the same return from Bilal and Company? Junaid?
Yes, sir.
So let's say if Microsoft pays 8% return on their bond, so your expectation from Microsoft bond is 8%. This is expectation. This is something that you want, okay? Do you think you will have similar expectation from Bilal and Company?
No, sir, not at all.
Yes. And let's say, for example, what would you go for? Just give me a random number.
Sir, maybe 4%, 5%. It all depends on the organization's reputation and image and credibility. And
so you said 5%?
Yes, sir, 5% maybe.
Why 5%, Junaid?
Sir, I'm just giving.
Okay, so Microsoft, it's a low risk company.
Yes.
This one is high risk.
Yes, sir.
Okay, so probably you heard this name for the first time, Bilal and Company, right?
So
let's say, as an investor, if you're getting 8% return on Microsoft bonds, you're okay with it. Okay, will you be okay with 5%? The answer is, of course, no.
Yes.
You will need more, way more. So let's say 15%. Why? Because Microsoft has low risk, Bilal and Company has a high risk. So in order to compensate me for a higher risk, I will need a higher return.
Okay, okay. What I would be expecting from them, that's what you were asking.
Yes, expectation, right? Okay.
Okay.
So market price is a function of 3 factors that determine price, present value. Of course, the dollar amount that is received, which is, in this example, 1 million here, okay? And the length of the time, of course, if it's here 20 years, and this formula, as the formula suggests, so we are concerned about the dollar value, N, which is the number of years, and then the interest rate, okay, and the market rate of interest. So present value or the market price, because market price, it's a similar concept to calculating present value. Okay, and the way we calculate present value is future value divided by 1 plus I raised to power n. So in order to calculate present value, in other words, in order to calculate the market price of particular bond, what we need? we need a dollar amount, okay, interest, and number of years. Can you see it from the formula now?
Yes, sir.
Perfect. Okay, so we need these three things. Now, example. Okay. Now, this is something that I do not expect from you in this course. Okay, because this is something that you should have covered in financial management. So there is a company on January 1st, 2017, they issue 100,000 of 9% bonds. So this is the coupon rate. Okay. What is this? This is face value. Okay. Due in 5 years. This is number of years. With interest payable annually at year end. The purchaser of the bond would receive the following two types of cash payments. Principal amount to be paid at the maturity. Number two, $9,000 interest payments. And how do we calculate? $1,000 multiplied by 9%. So this is coupon, okay? What is the value of the bond assuming a market interest rate of 9%? So coupon bond rate and market rate of interest, they are two different things, okay? Let me give you something as said. I mean, I do not expect you to learn it, but for example, let's say there is a rate, it is called risk-free rate. Normally, this is the rate which a government security pays, okay?
Sir, do we use the risk-free rate and the market rate here and beta too?
We use,
but it had these things in it.
We use market rate.
Yeah.
Okay. So let's say if risk-free rate in Pakistan, let's say on PIBs, Pakistan investment bonds, let's say if it's 8%. Okay. So my market rate would be more than 8. It will be market rate will be more than 8%. Why? So market rate more than risk-free. Why? Because there is no risk here. So let's say if a risk-free security is giving me 8%, if I'm buying anything else, like this company's bond, I'm expecting more because of the risk. And because of the higher risk, I need higher compensation. And that compensation comes in form of higher interest rate. Can you see my point, both of you?
Yes, sir.
Yes, sir.
Okay. Now, risk-free rate is determined by central banks, like State Bank of Pakistan in this situation. Okay?
Okay.
And let's say they would like to, let's say, encourage investors to actually borrow money. So what they do, they decrease the interest rate. But sometimes what they do, they actually tighten their monetary policy. They call it tightening of monetary policy. So they increase interest rates. Okay, so let's say if the interest rate is increased to 12%. Okay, so it was increased, although I mean they are increased only like in decimal. They call it basis points. Okay, but let's say there is a huge increase by 4 percentage points. Do you think this market rate will be adjusted? So suppose if the risk-free rate in situation number 1 was 8% and market rate was, let's say, 13%. Okay. Now in situation number 2, today State Bank revised their rates and they increase rates from 8% to 12%. Do you think that the market rate will be adjusted accordingly? Junaid, what do you think?
So I really don't have an idea about this. I'm not getting
Any guess? I mean, give me a guess. This is a little bit too much for you guys, but I'm trying to tell you something very important here.
So if I give a guess, that will be pointless. Kindly I'm not understanding this.
Okay. So if the risk-free rate is 8%,
yes,
and on this particular bond, because this is risk-free, there is no risk. I'm not taking any risk, and I can get 8% return. But on the other hand, let's say if I'm buying this company's, Acropolis company's bond, right? I need more than 8% because 8% is risk-free. Acropolis company has some sort of like risk associated with it, so I will need compensation for that. So suppose I'm assuming that number is 13%. But all of a sudden, State Bank, let's say after 1 year, thinks that, okay, we have to contract our monetary policy, which means that they increased, they call it also the policy rate, to 12%. So of course, this rate will also be adjusted upward. Okay? So let's say if this rate is adjusted, of course, the value of this bond will go down, and I'll show you why. Okay? So if you remember from the previous slides, the face value of the bond is $1,000, and this is a coupon rate. So each year, the bondholder is getting $9,000 at the end of each year. Okay? So how do I calculate the market value of the this bond? What do I do? Actually, I calculate present values of all these cash flows. Okay?
okay.
And once I calculate those cash flows, it's here. So the total of $100,000, if I discount it for 5 years at a rate of 9%, which is this rate, okay, 100,000 in present is actually equal to 64,993. And when I discount all those individual $9,000, it's equivalent to $35,007. Okay. Now the market price of the bond, if I add everything, it's equal to 100,000. Why 100,000? I'll show you actually. Let me give you. Anyways, let me give you an example here. If market rate is equal to coupon rate, then bond is sold at par or face value. So if you see from the question, coupon rate was 9%, and then my required rate was also 9%. So that's why the bond is sold at face value, which is 100,000. But what if, let's say, what if market rate is more than coupon rate? Then of course bond will be sold at discount.
Okay.
Okay.
Got it.
And then let's say if the market rate is less than the coupon rate, it will be sold at premium. I will actually cover these topics in my coming lectures, so don't worry about this one right now. Okay, let me test your knowledge now. Junaid.
Yes, sir.
Okay. Read this question. So mortgage bonds and sinking fund bonds are both examples of secured bonds. So mortgage bond, yes, and sinking fund bonds, they are examples of secured.
Yes, sir, it's true.
True, perfect. Love you. Okay, secured bonds are also known as debenture bonds, unsecured.
Yes, sir, true, sir.
True. Perfect. Humayun, good. Okay, Humayun, number 3. The stated rate is the rate investor demands for loaning funds.
False.
This is false. And do you see the point?
Yes.
Sir, I haven't understood this.
Okay, so I tried to explain it here. So this is the stated rate. This is coupon rate. It is also called stated rate. Okay.
Yes, sir.
So this is something written on the face of that. Let me go back. This one. Okay. So this is stated. This is written on bond. Okay.
Okay.
This required rate of return. This required rate of return. Let me this one. This required rate of return is actually dependent on so many factors. One of the most important factor is how is, let's say, the policy rates or the risk-free rates, let's say, responding. So let's say if the state bank increases their policy rate, of course, the required rate return adjusts accordingly. So if state bank decreases the rate, the required rate of return also decreases. If it increases, it also increases. So the point is, the stated rate is the rate investors demand. No, it's not, because stated rate, it was whatever written on bond, and this one is whatever is demanded. And from demanded, what I mean, the investor demands it based on risk. So if a company is more risky, of course, they need a higher return. If it's less risky, they need a comparatively a lower rate of return. Because higher risk, the return is also higher. Okay. Question number 4. Junaid, go ahead. The face value is the amount of principal the issuing company must pay at the maturity date.
Sir, what does maturity date means here?
So let's say a bond of let's say $1,000.
Yes, sir.
Okay, this is the face value of the bond, and there is another stipulation. For example, let's say 9% coupon or the stated rate. So how does the timeline look like? 0. So they get, let's say, $90 at the end of first year. How 90? 9% multiplied by 1,000. At the end of second year, $90. Sorry, 3 years, $90. And then let's say the maturity is in 10 years. At the end of 10 years, they get $90 in coupon, but the investor also get their $1,000 back. So yes, this is true. The face value is the amount of the principal the issuing company must pay at the maturity date. So this is true. Okay?
Okay, sir. Okay.
So there are 2 types of returns. One in the form of coupons, and then the bondholders also get their money back at the end of 10 years maturity. It's just like your deposit. If you deposit your money in a bank and let's say keep it for 10 years, you get that money back again, and on top of that, you also get your return. True?
Okay.
True.
Okay. The market price of a bond is equal to its maturity value.
False.
This is false. Because the market price is dependent on required rate.
It's adjustable, yeah.
Yeah. And it keeps on adjusting. As I said, I mean, it moves with the central bank policy rate. Okay, I will stop here. Any questions from you? Any questions, Junaid?
No, sir.
Okay. So this is my email. I'm sure you already know. We already have a WhatsApp group. So if you have any questions, please do not hesitate. Okay.
Sir, now when's going to be our next class?
Next class would be Thursday.
So we're sticking to one interactive session?
So as I said, let's discuss those possibilities in the next week.
Okay, fair enough.
Okay, perfect. So I wish you all the best. Eid Mubarak in advance.
Sir, Eid Mubarak. Sir, what about attendance?
Attendance, oh, that's a good thing. Thank you for reminding me, so I can actually download my attendance right now.
Oh, okay.
And I already did that. Thank you very much for reminding me, Humayun.
Okay, sir. Thank you, sir.
Okay, all the best.
Take
Enjoy
care.
करें, ठीक है, ईद को अपने parents के साथ, अपनी family के साथ. And inshallah, I'll see you next Thursday.
Okay,
sir. Thank
Thank
you.
Have
you.
a great day.
Okay, sir. Hafiz.
Okay, over now.